going to be this long, by the way. This is just the most important one. Now, let's go to the next do. Oh, wait. Let's make sure we got that down. Don't bet your house. Please, people, do not bet your house. Now, second rule of investing, third rule, second do. Diverse accordingly. Now, what does it mean to diverse, and what does it mean to do it accordingly? A diverse portfolio is a portfolio, by the way, a portfolio is the stocks that you own that make up your entire investment liquidity. And a diverse portfolio is one that is built up of different stocks in different sections of the market. And so let's say I start to get into investing and I research this company. I research this company called Amazon, okay? And I think, this is a good stock, I'm gonna buy this stock. Now I have, let's say, I was given $100,000 to invest, right? For example. And this is the money that I'm going to be investing for the next 5 years, and I'm going to be controlling as my portfolio. Now, I haven't really found other stocks that I want to buy into, so I'll just buy $100,000 of Amazon stock until I find something else, and then maybe I'll change up the money. But right now, I'll just have my entire portfolio made up of Amazon. That is not a diverse portfolio because this portfolio is made up of one stock and obviously one section of the market. While some companies may be controlling different sections of the market, generally a diverse portfolio isn't breaking down the different types of sections within a company, just different companies and what each company represents as a section. Amazon is technology and also retail, e-commerce. So now I have $100,000 in this one stock. The reason this is bad to have a very undiverse portfolio is because now my entire portfolio acts with one stock, and one stock or one company acts volatile. Is a very volatile graph. So Amazon has an earnings date 4 times a year, like any other company. That means in one day, a company can go either, for example, Amazon not being too volatile, but still a surprising company that surprises its investors sometimes. On an earnings call, it could go up or down, depending on if it's surprised for the better or for the worse, up to 10% and even more in some cases. Usually, a more realistic volatile move would be something like 5% gain or drop, or even more, of course. And if $100,000 that I'm invested in are in Amazon, then I just lost $5,000 within seconds, within the a minute after they posted these results. So let's say I do have a diverse portfolio, and say I'm invested in tech and retail, and I'm also invested in cybersecurity, which would be, let's say, some cybersecurity company, just making something up. I also want to invest in a real estate company. I'm not going to be naming too many real companies because I don't want you to really build your portfolio based on this rule. This is just for an example. I'm basing myself on different parts of the market that I think I should invest in. And also, these can also be shorts. For example, if I think real estate is really going to go downhill, I can have a short here. What's it called? A position here that is bullish. And so on and so on. But having multiple different shares and stocks up to, for example, Warren Buffett's portfolio, he says, should consist at least of 30 stocks, is a very diverse portfolio. So he's not going to have days where he doesn't have $100,000, but where his portfolio moves 5%. He's going to have bad days where it goes down 0.5%, and he's going to have good days where it goes up 0.5%. And different people have different investing styles. I like to keep my portfolio under 10 stocks, so it's a little less diverse, so I can capitalize on bigger moves and have 2 or 3% days. And of course, sometimes my portfolio is a little bit more volatile or a little less volatile than that. But some people would like to be with 4 or 5 shares and even less. But when you are only invested in one share, as for example many people are with Bitcoin or for example Tesla, then they are very, very prone to big moves in the market. So when Tesla has a bad earning call, or their CEO that is a very outgoing person throws out a tweet that drops the company 17%, their entire investment, which may contain millions of dollars, can go down 17%. This is what happens when your portfolio isn't diverse. So that's a big do. Now, let's go to our next don't. And this is called FOMO. And FOMO stands for fear of missing out. FOMO. Now, what do I mean by that? When you're looking at a stock and you are thinking of buying or selling or whatever and acting on that specific share of a company, you are sometimes going to go to very, very on the edge type situations of the investment. For example, you want to invest very badly, but at the same time, you think it might be dangerous. For example, I had this with a company which is BYND by their ticker price, and the company is Beyond Meat. If you have heard of it, it is a company that makes meat out of vegetables, but I'm not going to go too much into the company. And I was on the fence on this one. For some reasons, I wanted to invest in it heavily. Like, for example, the fact that it was innovating at a very fast rate in a department of the market where no one else is active. But for other reasons, like their very high PE ratios, which if you don't know what that is, we have made a video on that. You can look for it in our archive of videos. Their PE ratio was very, very high, so the market was already expecting quite a bit from them. And I was very, very scared to invest in them, but at the same time, I really, really wanted to. And it was a very, very hard decision. I was on the fence. And I made a mistake. I bought it. Not because the good things overweighted the bad things, but because I had a fear of missing out. I had seen this before. I had seen stocks go from a low valuation of 7 billion to hundreds of billions. And I had a fear of missing out on that huge upturn. And this was a mistake. I lost money in that company. By the way, I made money by being on a very long bull ride, and then I didn't sell, even though my fears of the company had gotten worse because they were even more overvalued, and then I didn't sell. But that's not the general lesson. I made a mistake, even whether I made money or not on that trade, because I had a fear of missing out. And that is what drove my decision. And that should not fuel your decisions. Your decisions should have logic. That is weighting the risks and the rewards. Risks and rewards. And that's something people do more often than not when the risks and the rewards are exactly at the same place, and maybe you should just leave the company alone. And they go, well, I have a fear of missing out on these rewards, so I'm going to buy. And that is a mistake, because you are not acting with logic. Now, let's get to our last do for the day, before we get to our last don't of the day.